Bernie Madoff was a name that, for decades, represented success, wealth, and trust in the financial world. Many considered him a genius, a man who had an unmatched ability to generate returns for his clients. But behind the polished image, the charisma, and the Wall Street fame, Madoff was orchestrating what would become the largest Ponzi scheme in history. To understand his story, we need to look at both the man and the system he exploited. Born in 1938 in Queens, New York, Madoff was the son of a stockbroker. From an early age, he was exposed to the world of finance, watching his father navigate the complexities of the market. After graduating from college, he started his own investment firm in 1960. At first, it was a small operation, but Madoff was ambitious and, more importantly, convincing. He built a reputation for consistently high returns, something that attracted wealthy individuals, charities, and even institutions. People trusted him because he was seen as smart, ethical, and successful. The core of Madoff's scheme was deceptively simple. Unlike legitimate investment operations, he was not really investing most of the money he received. Instead, he used the capital from new investors to pay returns to earlier investors. On paper, everything looked perfect. Clients were seeing steady profits year after year, and Madoff became the go-to figure for those who wanted their money to grow safely. No one could have suspected that behind the scenes, the firm wasn't making any real trades for the bulk of its clients. For decades, Madoff's reputation protected him. He had been a chairman of the Nasdaq Stock Exchange, a respected member of the financial community, and an advisor to many charitable organizations. His social status and connections gave him credibility that discouraged scrutiny. Even when regulators tried to investigate, Madoff was skilled at deflecting attention. He created fake account statements, fabricated trading reports, and made sure his operations looked legitimate. It was the perfect illusion. Madoff's scheme thrived for years because of one key factor: greed combined with trust. Investors were eager for the seemingly stable returns, and they rarely questioned the details. Many were drawn in by the allure of consistent profits during times when the market was volatile. Madoff played on human psychology expertly. He used his reputation to reassure clients, and he promised exclusivity by only accepting investors by referral, which made people feel special and part of an elite circle. The collapse came during the financial crisis of 2008. As markets crashed, many investors wanted to withdraw their funds, and Madoff suddenly faced a problem he could not solve. He did not have enough money to cover the withdrawals. The house of cards that he had built over decades came tumbling down. Madoff confessed to his sons, who then reported him to the authorities. The scale of the fraud was staggering. Estimates suggest that the losses exceeded $65 billion, though the actual cash lost by investors was around $20 billion. The aftermath was devastating. Countless individuals lost their life savings. Charities, small investors, and financial institutions were left reeling from the collapse. Families were shattered, and trust in the financial system was deeply shaken. Madoff himself was arrested, tried, and in 2009, sentenced to 150 years in prison. He would spend the remainder of his life behind bars, dying in 2021. But the legacy of his actions lives on. What makes Madoff's story particularly compelling is how he exploited not just the financial system, but human nature. His brilliance lay not in making money through investments, but in creating a narrative of success that people wanted to believe in. His ability to maintain the illusion for so long is astonishing and terrifying. Regulators, auditors, and investors all missed warning signs, and it serves as a stark reminder of the importance of skepticism and diligence in finance. Even today, the impact of Madoff's fraud is studied in business schools, legal courses, and ethics discussions. It is a case study in greed, deception, and the dangers of blind trust. His name has become synonymous with financial fraud, a cautionary tale that shows the dark side of ambition and human credulity. While we often think of Ponzi schemes as small-time scams, Madoff's operation demonstrates that with charm, patience, and calculated manipulation, even the most sophisticated and affluent communities can fall victim. Bernie Madoff's story is more than just a tale of one man's greed. It is a reflection on society, the allure of wealth, and the lengths people will go to protect their reputations. It reminds us that appearances can be deceiving, and that vigilance is always necessary when it comes to money. The legacy of his fraud continues to ripple through the financial world, shaping regulations, investor behavior, and the way we view trust in finance. Madoff may be gone, but his story remains a lesson, stark and unforgettable, on the consequences of deceit on a massive scale.